You found the company you want to invest in and did a bit of research into its financial health by looking at the balance sheet. The company has a lot of assets and is low on liabilities. The biggest hesitation you have now is that the market has been flooded with quality competition over the last few years, and you can't help but think this company may not be as dominant as it once was. And if it's not selling as much product as it once did, will that lower cash flow quickly chip away at that balance sheet that you think looks so good? Today, we're going to be talking about the operating cash flow ratio. Financial ratios can be invaluable to investors making decisions about companies that they might want to invest in. A variety of ratios are used by individual investors, institutional investors, and professional analysts. Usually, financial ratios are organized into 4 categories. They are profitability ratios, liquidity ratios, solvency ratios, and valuation ratios or multiples. The operating cash flow ratio is a liquidity ratio and is an indicator which helps to determine whether a company is able to repay its current liabilities with cash flow coming from its major business activities. In other words, the operating cash flow can show how much the company gets from its major business operations per dollar of current liabilities. This ratio is preferred by analysts as a more precise and accurate parameter of the company's liquidity. Since earnings are more easily manipulated, using cash flow is preferred as a more effective measure. You'll find the operating cash flow from a company's cash flow statement. There is also a special formula to determine the operating cash flow if it's not explicitly outlined, which is calculated as a sum of net income plus non-cash expenses plus working capital changes. The cash flow from operations, or OCF, is a key metric in a company's account statements. It shows how much cash a business can generate exclusively from its major operations. Investors closely view the OCF as it gives them a clear picture of the company's overall value and health. Cash flow from operations serves as a cash equivalent of net income. It means the cash flow after deduction of operating expenses before the start of new financial activities. As already mentioned, investors often choose to follow cash flow from operations over net income because here the risk of manipulating results is much lower. However, seen together, net income and operating cash flow provides a good way to estimate the quality of a company's earnings. Failure to maintain a positive OCF is a trigger, which lets you know that the company probably won't stay solvent in the long run. A negative OCF shows that the company has not enough revenues from its major business activities and needs to reproduce a positive cash flow from additional investments and financing. Again, the ratio serves as a measure of the company's liquidity. When the operating cash flow is lower than 1, the business generates less cash than expected to repay the short-term liabilities. It brings a need for more capital. The ratio higher than 1 is considered positive and favorable, as it shows the company is pretty strong with enough money to pay off its current liabilities and have more capital left over. Companies with a gradually increasing and high operating cash flow ratio are regarded as strong businesses in good financial health. Let's look at an example of using the operating cash flow ratio. Let's assume that the current liabilities of a retailer called Zorbart, since I can't talk about financial products, was 155 billion, and another, Bosslow, was 35.2 billion respectively as of April 22. In this time period of the year, Zorbart had operating cash flow of 55.6 billion and Bosslow had 12 billion. Considering the formula for operating cash flow ratio, the ratio will be 0.36 for Zorbart and 0.34 for Bosslow, which is the 12 billion divided by the 35.2 billion. As the ratio results here are almost the same, it means that both the companies have pretty much the same liquidity position as well. The results from this metric alone probably wouldn't give you enough of the information you need to select one over the other to invest in, but it can contribute as one of the many metrics you choose to look over during this time of decision-making process. The common feature of operating cash flow ratio and current ratio is that they both help in measuring the short-term debts and liabilities that a company owes to its debtors. While calculating the operating cash flow ratio, cash flow from operations are considered to pay off current liabilities, while for calculating the current ratio, the company uses its current assets. Depending on the type of business, these two ratios could be like night and day because, for example, a tech company could have far less tangible assets compared to a mining company, potentially skewing the current ratio. I've done a video on current ratio and we'll link it at the end of this video. As with most other metrics, companies can still manage to manipulate operating cash flow ratios, though usually not as much as net income. For an example, there are some companies who might exclude depreciation costs from revenues, even if it doesn't reflect a real cash flow outflow. Depreciation expenses refers to the gradual writing off the value of assets over a period of time. Ultimately, companies should follow the policy of adding depreciation expenses to cash while calculating cash flow from operations. For you, this just means do your own research and calculations before making any big decisions.
Hey, thanks for watching. If you liked this video, please like and subscribe. If you didn't like the video, that's okay. Please still subscribe and I'll continue trying to improve to win you over. We're just getting started.